Imagine walking into a bank and being offered a house with zero money down. For many people, that dream became a frightening reality during the year 2008. You probably heard stories of families losing savings they spent decades building. Today, we are exploring why that enormous housing bubble eventually collapsed completely. Understanding this history matters before you sign your very first mortgage agreement. The housing market looks simple on the surface, but behaves like a dangerous animal underneath. Many experts believe similar warning signs are quietly forming in markets today. The year 2008 proved that nothing lasts forever inside a global financial system. For years, people believed home prices could only move in one direction upward. Banks handed out enormous loans as casually as if money had no real consequences. This behavior created a false sense of wealth for millions of everyday working families. People purchased second and third homes expecting easy profits through quick resales. The entire experience felt like a celebration that would never actually end. Then suddenly, the music stopped and the financial system began showing serious cracks. Understanding how that collapse happened helps protect your money in uncertain times. The story begins with interest rates remaining extremely low for an extended period. Low rates made saving money feel pointless compared to chasing higher investment returns. Investors searched desperately for returns better than what bonds could provide. Housing appeared stable, predictable, and nearly risk-free at the time. Wall Street engineers created complex products using ordinary home loans. They bundled mortgages together and gave them impressive-sounding financial names. These products became known as mortgage-backed securities across global markets. Banks stopped caring whether borrowers could realistically repay their loans. Their goal was collecting fees and selling loans to investors quickly. This environment gave birth to what became known as subprime mortgages. Subprime loans targeted borrowers with weak credit histories and unstable finances. Some borrowers lacked steady income, savings, or even long-term employment. Lenders rarely verified income, assets, or actual repayment ability. These were nicknamed ninja loans because borrowers had no income or jobs. Buyers could sign paperwork for homes costing hundreds of thousands easily. Banks assumed rising home prices would cover any future missed payments. If borrowers failed, homes could supposedly be sold at higher prices later. That logic worked perfectly only while prices continued rising steadily. Eventually, home prices stopped rising and the entire system became vulnerable. Wall Street did not slow down after early warning signs appeared. Instead, they created even more complex layers on top of risky loans. Credit rating agencies labeled these investments extremely safe for investors. Many securities received the highest possible safety ratings available. These ratings convinced cautious institutions they were buying stable assets. Pension funds, universities, and local governments invested massive sums. They believed these products were as safe as government-issued debt. In reality, these investments were built on fragile borrower foundations. The true risks remained hidden beneath layers of financial engineering. Builders responded by constructing new homes at an extraordinary pace. Entire neighborhoods appeared seemingly overnight in distant suburban areas. Housing supply increased rapidly because demand looked endless at the time. Homeowners began treating their rising equity like unlimited personal credit. They borrowed against homes to fund cars, travel, and luxury purchases. On paper, everyone appeared wealthier without earning more income. The foundation of this wealth rested on unstable assumptions. Eventually, the number of new homes exceeded the number of qualified buyers. At the same time, inflation pressures began worrying financial policymakers. The Federal Reserve responded by slowly increasing interest rates. Higher rates caused adjustable mortgage payments to rise sharply. Many subprime loans included payment increases after introductory periods. Borrowers who struggled initially became unable to afford new payments. Selling homes became difficult as fewer buyers qualified for loans. Homes flooded the market as owners attempted quick exits. When supply rises while demand falls, prices adjust downward rapidly. Home values declined nationwide for the first time in generations. Many homeowners owed more than their homes were worth. This condition is known as being underwater financially. Being underwater removes incentives to keep paying mortgages. Millions chose to walk away and surrender properties to lenders. Banks suddenly held massive inventories of unsellable homes. The value of mortgage-backed securities dropped sharply. Financial institutions relying on those assets faced severe liquidity problems. Large investment banks struggled to meet short-term obligations. Confidence between financial institutions disappeared almost overnight. Banks stopped lending to each other out of fear. This freeze created a global credit slowdown affecting businesses everywhere. Companies struggled to finance operations and payroll expenses. Economic activity slowed dramatically across many industries. Governments intervened with enormous financial support programs. Public funds stabilized institutions deemed essential to the economy. Taxpayer money prevented deeper systemic damage. Public trust in financial systems suffered lasting damage. Debt was no longer viewed as harmless or always manageable. First-time buyers today must learn from these painful historical lessons. Never purchase a home solely expecting rapid price appreciation. A home should always be shelter before becoming an investment. Buying only makes sense if you plan staying at least 5 years. Transaction cost quickly erase profits during short holding periods. Monthly housing payments should remain below 30% of income. Banks may approve higher amounts than you should comfortably accept. Their calculations protect institutional profits rather than household stability. You must protect yourself through conservative financial planning. An emergency fund is essential before taking on long-term debt. Unexpected repairs and maintenance costs are often underestimated. Roof repairs and plumbing issues appear without warning. Fixed interest rates provide stability during uncertain economic periods. Adjustable loans introduce payment risks many buyers underestimate. If terms feel confusing, slow down before committing. The housing collapse demonstrated how quickly optimism can disappear. Regulatory oversight failed during a critical expansion period. Risk accumulated quietly while profits distracted decision makers. Households borrowed aggressively believing prosperity would continue. Today, lending standards are far stricter than during 2006. Borrowers must verify income, employment, and credit history. These requirements reduce the chance of widespread loan failure. However, home prices remain high relative to average incomes. This imbalance requires greater caution from modern buyers. Fear of missing out often leads to poor financial decisions. Patience usually delivers better outcomes than emotional urgency. The right home should fit your budget comfortably. Peace of mind matters more than market hype. Understanding past bubbles helps identify future warning signs. Rapid price growth without wage growth signals danger. Low down payment offers should raise immediate caution. Easy credit often precedes periods of financial stress. Markets reward discipline over excitement long term. Buying during calm periods often yields better value. Avoid following crowds driven by speculation. Financial stability comes from steady, informed decisions. Housing markets rise and fall over long cycles. Survival during downturns matters more than peak timing. Wealth grows through patience and thoughtful planning. The lessons of 2008 remain relevant today. Your future depends on choices made with clarity.